This isn't a gold chart story, it's a custody and trust story. If you are staring at the screen right now thinking, gold is up again, 4,700, this is crazy, you're still watching the wrong part of the system. Because the real story in 2026 isn't just that gold is higher. The real story is that the world is starting to ask a question it hasn't asked out loud in decades. Where is my money? Really? Not the number on the statement, not the number on the app, not the number on the screen. Where is it? Who holds it? Who can freeze it? Who can delay it? And in a trade war world, who can weaponize it? About 45 minutes ago, gold printed a new all-time record around 4,137 an ounce. It didn't just tag it, it lingered long enough here. And while the internet is busy arguing about whether this is a blow-off top, something else is happening in the background. Institutions are moving like they no longer trust paper promises the way they used to. Let me paint the scene. Earlier today, gold was already grinding higher. The tone felt tense, not euphoric. Then the why hit the wires. The safe haven stampede is accelerating because the US-Europe situation is turning ugly, fast. Tariffs, retaliation talk, political theater, threats tied to Greenland, diplomatic friction that spills into markets. And in the middle of all that, Europe is revisiting a taboo topic, repatriation. Germany and Italy have enormous piles of gold, and a meaningful portion of that gold is stored on US soil in New York, inside the Federal Reserve's vault ecosystem. For years, that was normal. It was a post-war trust arrangement. It was liquidity. It was strategic partnership. But when trade war language comes back, when alliance language gets sharp, people stop talking about yield and start talking about sovereignty. And that is what gold is pricing. Not inflation, not CPI, not some influencer chart pattern. Gold is pricing the return of an ancient fear, counterparty risk. Because the moment a nation, even a rumor, even a debate, starts asking, should we bring our gold home? The market hears a much darker sentence underneath. We're not sure the world will cooperate when we need it to. That's why this move matters. Most people still think of gold as an investment. In 2026, gold is behaving like a safety mechanism, like a circuit breaker, like a fire exit. And when people start rushing for the fire exit, you don't get an orderly line, you get a stampede. Now, here's what retail gets wrong. Retail thinks this is a contest of opinions. One side says gold is a bubble. One side says gold is going to $10,000. They fight in the comments like this is sports, but you know what serious players do? They don't argue, they don't post, they don't flex, they check one thing. Can I get metal in size, with certainty, under my control? Because the difference between a paper asset and a hard asset is simple. Paper needs permission to be true. Gold does not. Gold doesn't care what a central bank says. Gold doesn't care what a regulator says. Gold doesn't care what a bank's risk committee says. Gold is either in your custody or it's not. And that's why the repatriation narrative is gasoline on this rally. This isn't just buying gold. This is moving away from paper money. Let's define what I mean by paper money because people get emotional here. Paper money is not evil. Paper money is efficient. It runs the world. But paper money is ultimately a confidence system. It is a network of trust me. Trust the issuing state. Trust the banks. Trust the settlement rails. Trust the courts. Trust the alliance. And when the world feels stable, that trust is invisible, like oxygen in a room. When the world gets tense, that trust becomes the only thing anyone can talk about. Now imagine the oxygen starts getting thin. Nobody panics at first. Then somebody coughs. Then somebody notices the door is locked. And then everyone realizes at the same time that they want the same thing, an exit. Gold is that exit. Not because gold is magic, because gold is not a promise. Gold is settlement. If you want the cleanest way to understand this entire move, it's this. In 2026, we are watching a mass upgrade from claim money to settlement money. Claims can be delayed, settlement can't. Claims can be renegotiated, settlement can't. Claims can be frozen, sanctioned, haircut, or converted by decree. Settlement sits there and dares you to argue with physics. That's the psychology behind $4,700. Now let me take you inside the two rooms that matter, because this is where most people get lost. Room 1 is the trading room. Bright screens, fast prices, loud opinions, green candles, red candles. Breakout, crash, manipulation. It feels like the world. Room 2 is the vault corridor. Silent, slow, boring, controlled. There are no rocket emojis in the vault corridor. There are only clipboards, seals, serial numbers, custody chains, and insurance riders. In the vault corridor, nobody cares if gold is up $80 today. They care if the metal is allocated, unencumbered, and reachable. That's the split that defines 2026. Price is the loud story, custody is the real story. And the reason repatriation is such a powerful word is that it drags the conversation from room 1 into room 2. It forces the market to think about jurisdiction. Because if your gold is stored abroad, you don't just have exposure to price. You have exposure to politics. You have exposure to legal systems. You have exposure to emergency rules you don't control. You have exposure to, we'll get back to you. And in a world where the US and Europe are openly threatening each other with tariffs, that sentence, we'll get back to you, starts sounding like a nightmare. So let's talk about the part people don't want to visualize. Repatriation is not a tweet. Repatriation is not a press conference. Repatriation is logistics. It's metal being audited. It's bars being checked. It's transport being arranged. It's security being planned. It's insurance being priced. It's schedules being negotiated. It's officials avoiding the appearance of panic while doing the exact thing panic requires. That's why just talking about repatriation moves markets, because markets understand if the most sophisticated actors are thinking about the physical location of reserves, then we are no longer in a normal confidence regime. We are in a regime where custody itself has a premium. And once custody gets a premium, paper claims start trading with a discount, sometimes quietly, sometimes violently. Now here's the uncomfortable part. The public rarely gets to see that discount directly. The public sees the spot price, but the system sees a spread. The spread between exposure and possession. The spread between claim and control. The spread between paper gold and allocated gold. When that spread widens, the chart can lie to you. You can watch gold dip and still have custody demand rising. You can watch gold surge and still have the real stress building underneath. Because the stress is not the candle. The stress is the question. If I needed this asset in a crisis, could I actually access it? And when you hear custody premium, don't think that means the world suddenly becomes dramatic overnight. It usually looks boring at first. It looks like a lawyer asking for updated custody language. It looks like a reserve manager asking whether bars are allocated or unallocated. It looks like a board member asking if we needed the metal during a crisis week, who signs off. It looks like a procurement-style checklist, but for money. Because here's a dirty secret about modern finance. A shocking amount of ownership is actually shared, netted, rolled, or promised. That's not fraud. That's how liquidity works. But it means there are layers of claims sitting on top of the same underlying pool. And in calm times, nobody cares. In tense times, everyone cares at once. This is why gold custody is different from gold exposure. Exposure is a line item. Custody is a location, a chain of control, and a legal jurisdiction. And if you want to understand why Germany and Italy storing gold in New York even matters, it's because New York is not just a place. It is the center of global collateral. When assets are held inside the most trusted vaults in the most connected financial hub, they can be used for liquidity. They can be swapped. They can be mobilized. They can support confidence. So the original logic was rational, store gold where the financial heart beats. But here's what trade war politics does. It turns the heart into a pressure point. Because if your emergency reserve sits in the other team's stadium, the reserve stops feeling like insurance. It starts feeling like a hostage, especially when headlines get heated. Again, I'm not saying anybody is stealing anything. I'm saying the mere possibility of interference is enough to change behavior. Institutions don't wait for the fire to touch their desk. They smell smoke and move. Now let's talk about the paper gold illusion for a second, because this is where a lot of smart people still get trapped. Paper gold can be huge, it can be liquid, it can be convenient. But convenience is not the same thing as certainty. Paper gold is like a hotel reservation. Most nights, it works. But if the whole city fills up and everyone shows up at once, the front desk starts saying, "We're sorry, we can upgrade you to something else." Physical gold is having the key in your pocket. And that's why Exodus language is fair, because Exodus isn't about returns. Exodus is about fear of being upgraded out of your claim when you need it most. So when gold hits $4,700, what you're seeing is not just buyers. You're seeing a shift in what institutions are willing to accept as a final answer. They don't want cash equivalent. They don't want "we'll settle later." They want "show me the bar." That's also why the move can accelerate suddenly. Because once a few big players start tightening their standards, once they start demanding more certainty, the next layer of institutions feels exposed. Nobody wants to be the weakest link holding the softest claim, and that's how a slow trend becomes a sprint. That's why the chart is a distraction. The vault map is the signal, and when the vault map starts changing, price follows like thunder after lightning. You don't hear the lightning coming, you only see the flash, then the boom. Now here's the second layer that makes this moment feel bigger than a simple safe haven bounce. Currencies. A lot of people hear mass exodus from paper money, and they picture everyday people lining up, swapping cash for coins. That's not how this starts. This starts in Treasury departments. This starts in reserve committees. This starts in the boring rooms where people manage risk, not vibes. And the reason the US-EU trade war narrative is so dangerous is that it creates a scenario where both sides could feel forced to defend their currencies at the same time. That's where downward spiral language comes from. Trade war weakens growth. Weak growth pressures rates lower. Lower rates pressure the currency. Currency pressure triggers political pressure. Political pressure triggers intervention. Intervention triggers capital flight. Capital flight triggers more pressure. That loop is the spiral. And in a spiral, the smartest players don't wait for the bottom. They move early. Gold is the early move because gold is the neutral asset. Gold is the asset that doesn't need a passport. Gold is the asset that doesn't need a permission slip from the other side's banking system. Gold is the asset that still works when cooperation stops working. And you don't need a conspiracy to get there, you just need incentives. Now, there's one more reason this spike feels like a regime shift, not a normal rally. Look at what gold is doing psychologically. Gold is not just climbing. Gold is ripping through levels that used to be impossible. And every time it does, the mental model of the world changes for the average institution. When gold was $2,000, it was an inflation hedge. At $3,000, it was a warning. At $4,000, it was a credibility problem. At $4,100, it becomes something else entirely, a public scoreboard for trust, because no politician wants to explain why the ultimate anti-paper asset is screaming higher. No central bank wants to explain why the market is voting against the story. So every new high quietly tightens the fear loop, and that fear loop creates the most violent kind of demand, not I want upside, but I need safety. That demand doesn't buy gently. It buys urgently, in chunks, on moments of weakness. It doesn't announce itself. It just keeps showing up. That's why the path is usually not a straight line. It's a staircase with traps, a surge that forces attention, a pullback that tests conviction, a second surge that punishes sellers, a third surge that makes everyone whisper, okay, this is real. If you've been waiting for a perfect entry in a trust event, you'll wait forever. Trust events don't give comfort, they give deadlines. So if you want a simple way to track whether this stays real, stop chasing predictions and track behavior. Do officials start emphasizing trusted partner language more aggressively? Do more parliamentary groups demand audits? Do you hear more talk about domestic storage, strategic autonomy, and sovereign control? Do gold-related headlines shift from price to location? Because once the story becomes location, you're not in a normal bull market anymore. You're in a confidence migration. And in a confidence migration, the last thing that moves is the public. The first thing that moves is the metal. Now here's where silver enters the chat. Silver has breached $95 in the middle of all this. And silver is the stress meter. Silver is the pressure gauge. Gold is the trust vote. Silver is the supply vote. Gold says, I don't trust your paper. Silver says, I need your metal. That's why seeing gold at $4,637 and silver flirting with $95 is not just a metals rally, it's a statement about the system. In the West, this is no longer just investing. It's institutional panic behavior dressed up as portfolio management. Because if you genuinely believe the US-EU trade war could push the dollar and the euro into a mutual downward spiral, policy fighting policy, then you don't want to be the last institution holding pure paper exposure. You want something that survives disagreement. Now let's talk mechanics, because this is where people get faked out. There are two worlds again, just like silver. World one, the financial world, futures, ETFs, derivatives, leverage, paper claims. World two, the custody world, bars, vaults, allocated metal, transport, insurance, jurisdiction. Most years, those worlds move together. In 2026, the connection is being stressed. You can have paper supply that looks fine, while custody demand is quietly screaming. You can have price dips while physical tightens, because price is set in paper while the stress happens in delivery. If you don't understand that split, this year will eat you alive. So let me give you a picture you can't unsee. Imagine a giant institution that owns gold on paper. They're fine, they're calm, their spreadsheet looks great. Then their risk committee asks a simple question. If the world breaks, do we have a bar or do we have a receipt? That single question can move billions, because a receipt is only as good as the system that honors it. A bar is only as good as your ability to hold it. And in 2026, the system is starting to feel like it might get political. That is why repatriation is such a powerful signal. It is custody language. It is jurisdiction language. It is third-party risk language. Even talking about it shifts behavior. Because when a nation starts asking about moving gold, every other institution hears, maybe I should reduce my dependence on foreign custody too. And that's how a debate becomes a flow. Now let me be very clear. I'm not claiming some movie villain meeting happened this morning. No smoke-filled room where everyone agreed to dump dollars and buy bars. I'm saying the incentive structure is so obvious it might as well be a meeting. If you are a central bank, a sovereign wealth fund, a reserve manager, a giant insurance pool, or an institution that cares about tail risk, then 2026 looks like this. Trade friction rises. Sanction risk rises. Alliance reliability becomes political. Settlement becomes a weapon. Currency becomes a battlefield. And the rational response is not to predict the next candle. The rational response is to make sure your emergency assets are actually reachable. That is what gold is. Now, why did gold explode right now? Because the narrative finally crossed a line. From gold is rising to gold is being demanded. And the catalyst isn't one data point. It's a stack of fear triggers that all point in the same direction. A fragile geopolitical map, a reopening of tariff wars, a public questioning of institutions, a market that senses that rules are becoming negotiable, and a custody debate in Europe that makes people wonder who the world's vault really belongs to. When that happens, money starts moving before speeches are finished. This is why the move feels like an exodus. Exodus is not a number. Exodus is behavior. And behavior is exactly what changes when paper money becomes suspect. Let's bring Germany and Italy into focus for a second, because this is the heart of the first point. Germany already went through a repatriation era in the 2010s. They moved meaningful tons back to Frankfurt. That history matters because it proves something crucial. Gold can move, but it moves on a schedule. It moves under political sensitivity, and it moves in a way that signals distrust even when officials deny it. Italy has its own gold controversies too, questions over ownership, sovereignty, and the role of the central bank. So when the European conversation shifts from gold as an old relic to gold as a strategic asset, markets react. Because if major European holders begin pushing for more local control, it tells you one thing: the era of blind custody trust is ending. And once that idea hits, you can't put it back in the box. Now zoom out. If this is a trust story, then $4,700 is not a high. It is a message that the market is changing what it considers safe. Safety is not what pays the most. Safety is what survives conflict. And a trade war is conflict, just in a suit. Now here's the part nobody wants to face. When trust breaks, it doesn't break evenly. It breaks in phases. Phase 1, people hedge. Phase 2, institutions reweight. Phase 3, custody questions get loud. Phase 4, nations start thinking about repatriation and reserve strategy. Phase 5, the public notices and follows. Gold doesn't need Phase 5 to move. Gold moves when Phase 3 begins. And the headlines right now are Phase 3 headlines. Now, if you're watching the chart and wondering, shouldn't this be overextended? Here's the uncomfortable answer. In a trust event, there is no such thing as overextended. There is only how many people still believe the old story. Because gold's real fuel isn't greed, it's doubt. Doubt is the most underpriced commodity on earth until suddenly it's the only thing anyone can afford. Now let's talk about what you should watch if this thesis is real. Forget one candle. Forget one headline. Watch the plumbing. Here are the signals that reveal whether this is a real exodus or just a hype spike. 1. Physical premiums. If spot pulls back but premiums stay elevated, that's not speculation. That's demand for custody. 2. Allocation language. If you start hearing allocation, delays, limited availability, priority clients, that's the market telling you supply is getting managed. 3. Forward stress. Watch the shape of the curve. If near-term tightness persists, it implies urgency. 4. Custody politics. Watch for more mainstream politicians and institutions discussing where national gold is stored. That is a trust thermometer. 5. Currency behavior. If the dollar and euro both act fragile, if both need intervention narratives, that reinforces the exodus logic. You don't need to be perfect. You need to be directionally aware. Now let me address the emotional trap that destroys people in moments like this. When gold breaks records, people get hypnotized by the number. They think the number is the story. But the story is always the behavior behind the number. If institutions are moving out of paper money, then the path will not be smooth. It will be violent. You will get spikes. You will get smashes. You will get "it's over" headlines. You will get manipulation comments. You will get fake outs that punish late buyers and punish early sellers. Why? Because volatility is a weapon in every market where the underlying asset is scarce and desired. Volatility shakes weak hands. Volatility creates liquidity. Volatility transfers inventory from emotional holders to strategic holders. That's true in silver. It's true in gold. It's true in any market that becomes strategic. And in 2026, gold is strategic because it is the asset that doesn't require cooperation. That's the real meaning of exodus from paper money. It doesn't mean everyone hates paper. It means everyone is quietly preparing for the day paper is questioned. Now here's a line you should write on your mental whiteboard. In calm times, people optimize for return. In tense times, people optimize for control. Gold is control. Custody is control. Repatriation is control. And this is why today's move matters more than a normal rally. Because the story isn't gold is higher. The story is control is being valued more than yield. Now, what does this mean for silver specifically? Silver is going to behave like a battlefield metal in this environment because silver is the intersection of finance fear and industrial necessity. Gold is the reserve. Silver is the pipeline. Gold is the symbol. Silver is the bottleneck. So when you see silver breach $95 while gold prints $4,737, the market is telling you the panic is not just emotional, it's logistical. Because when currency trust is questioned, institutions run to gold. And when industrial chains feel threatened, they run to silver and physical metal inputs. Those flows can reinforce each other. And when they reinforce, you don't get a gentle bull market. You get a disorderly repricing. Now, I'm not here to promise targets. I'm here to give you a framework. If you want to understand where this goes, stop asking how high and start asking how much trust is left. If Europe keeps talking about repatriation, that's trust leaking. If the US-EU trade war escalates, that's trust leaking. If currencies start requiring more intervention narratives, that's trust leaking. And when trust leaks, gold rises, not because gold is worth more, but because paper is worth less. That's why I called it an exodus. Now your battle plan, again, not advice, a survival framework. 1, don't let the chart hypnotize you. 2, separate price from custody. 3, watch the political custody signals as closely as the macro signals. 4, watch silver as the stress gauge, because silver tells you whether the move is getting real-world traction. And 5, stay calm, because in a trust event, panic is the tax. The calm person doesn't avoid volatility. The calm person uses volatility to stay rational. Now let me close by bringing you back to the simple truth. Gold at $4,700 is not just a record. It is a warning that the world is repricing trust. And the moment nations start thinking about where their gold is stored, you are watching the system admit something quietly. Paper money works until it doesn't. And nobody wants to discover it doesn't while they're trapped in it. So here's my question to you. Do you still think today was about a gold candle? Or do you think we just watched the first visible wave of a global move away from paper promises and toward hard settlement? Drop a comment with one word. Paper. If you think this is hype, and charts will mean everything. Vault, if you think the real story is custody, control, and the exodus that just began. Stay sharp, stay calm. Because in 2026, gold is not just an investment, it's a verdict. And if that scares you, good. Fear is information. The question isn't whether gold is expensive. The question is who still trusts the receipt right now in 2026. Trade war risk doesn't just hit exports and imports, it hits the one thing the entire modern system runs on, currency confidence. Because the dollar and the euro are not just money, they're collateral, they're settlement rails. They're the oxygen masks the global financial plane uses when turbulence hits. And when a trade war starts to look like it could become a political split, the market begins to treat currencies the way engineers treat a bridge after an earthquake. Not as a symbol, as a structure that might fail under load. Let me explain what I mean without making it academic. In calm times, you hold dollars and euros because they're useful. They buy things. They settle trades. They clear invoices. They're normal. But in tense times, currencies become something darker. A permission system. Who can access them? Who can clear them? Who can be blocked from them? Who can be forced to convert? Who can be forced to hold? That's why trade war headlines can trigger a currency spiral even when the economic numbers look fine. Because the fear is not growth will slow. The fear is the rules will change while I'm inside the system. And once that fear becomes plausible, institutions start moving like it's already true. Here's the chain reaction, step by step, in plain language. Step 1, tariffs hit the conversation. Not a small tariff, not a symbolic tariff. A tariff framework that implies escalation and retaliation. Step 2, businesses realize costs will rise and margins will compress. That's growth pressure, that's earnings pressure, that's employment pressure. Step 3, markets start pricing easier policy, rate cuts, liquidity support, stimulus talk. And step 4 is where the spiral begins. Easier policy means weaker currency expectations. Weaker currency expectations mean capital gets nervous. Nervous capital moves early. Early moving capital creates the weakness it feared. That's the downward spiral. It's not magic, it's behavior. Now add one more ingredient, politics. In a trade war, currencies stop being neutral. They become negotiating chips. And when currencies become chips, every large institution starts asking a brutally practical question. If this gets worse, will my currency exposure be treated fairly? Because fairly is not a moral word here. It's a legal word, a settlement word, a custody word. This is why the phrase safe haven flows is too soft for what's happening. Safe haven flows makes it sound like a calm decision, like people are gently rotating. What I'm describing is more like a silent evacuation, the kind where everyone keeps their voice down while they pack, because they don't want to cause panic. But they do want to be out before panic arrives. And here's what makes this moment unique. The fear is not only that the euro weakens. The fear is not only that the dollar weakens. The fear is that both sides can weaken in a feedback loop because both sides will respond politically. If Europe gets squeezed by trade terms, Europe pushes back. If the US gets pushed back, the US pushes harder. That escalation threatens growth on both sides. Growth threats create policy pressure. Policy pressure threatens currency value. So instead of one currency being the clear winner, you get uncertainty across the board. And uncertainty is exactly the environment where gold becomes attractive, because gold doesn't need you to choose a team. Gold is what you hold when you don't want to bet your safety on a political outcome. Now, here's the part most people miss. When institutions say, I'm worried about the euro or I'm worried about the dollar, they're not primarily worried about the FX chart. They're worried about collateral rules, because large institutions don't run on vibes. They run on collateral. They pledge collateral to borrow. They post collateral to hedge. They mark collateral daily to satisfy margin. They swap collateral across borders to keep operations stable. So when trade wars create the possibility of friction, the big fear is, will my collateral still be accepted the same way tomorrow? Let me make it concrete. Imagine you're a global manufacturer. You have suppliers in one region, sales in another region, financing in another region. Your life is currency conversion and settlement timing. If political tension rises, the first thing you do is not panic buy gold. You do something more boring. You shorten your time horizon. You stop trusting long settlement chains. You stop trusting slow systems. You stop trusting we'll net it out later. You want immediate certainty. And that is exactly how paper money gets abandoned without anyone selling paper money. You don't need everyone to dump dollars. You just need enough institutions to reduce their reliance on the weakest part of the chain. They hold more hard collateral, they keep more reserves, they reduce unsecured exposure, they raise their standard for what counts as safe. That is an exodus, not a protest, a migration. Now, why does trade war accelerate this? Because trade war is a narrative that says cooperation is not guaranteed. And the modern monetary system is built on cooperation. It's built on the assumption that settlement is routine, that legal rules are stable, that access is predictable, that allies remain allies. Trade war is the opposite narrative. It's the narrative that says the map is changing. And whenever the map changes, money moves. Now let's talk about the paper money phrase, because some people hear it and think it's just emotional. Paper money here means anything that depends on a chain of promises. You have the currency itself. Then you have the bank that holds it. Then you have the system that clears it. Then you have the policy that governs it. Then you have the political relationship that keeps it neutral. That's a long chain, and a long chain is fine until it isn't. Long chains fail at their weakest link. So in moments like this, institutions do something predictable. They reduce chain length. They move toward assets that have fewer dependencies. Gold has fewer dependencies, not zero, but fewer. That's why gold behaves like an escape hatch in currency spirals. Now, there's a second part to this. It's subtle, but it's crucial. When currencies are under stress, policymakers often respond in ways that unintentionally increase the stress. They talk tough. They signal strength. They threaten retaliation. They try to control the narrative, but narratives don't settle invoices. Narratives don't clear trades. Narratives don't deliver goods. So the market starts separating words from mechanics. And once markets focus on mechanics, the logic becomes cold. If trade war escalates, supply chains get disrupted. Disruptions mean inflation in some categories and recession in others. That's the worst mix for policymakers. They can't tighten because growth is weak. They can't ease because inflation is sticky. So they wobble. And wobble is the enemy of currency confidence. That wobble is what institutions fear. Because institutional money doesn't need certainty about the future. It needs certainty about the rules. If the rules look negotiable, then paper money looks less like money and more like policy exposure. And policy exposure is not what you want in a crisis. Now let's bring the euro into focus. In a US-EU trade fight, the euro becomes a political symbol. It becomes a battleground for competitiveness. It becomes a point of pride. But pride doesn't defend a currency. Trade balances do. Energy prices do. Policy coordination does. Confidence does. And when Europe's relationship with the US becomes strained, investors ask, will Europe be forced to defend its economy at the cost of its currency? If that question becomes loud, capital flows adjust. Not because investors hate Europe, because investors hate uncertainty. And if Europe weakens, the dollar can strengthen. until the US responds with its own policies. Because a strong dollar can be a problem for exports. A strong dollar can tighten financial conditions. A strong dollar can break weaker borrowers abroad. And if the US feels those effects, pressure builds for the US to do something. So you can get a ping-pong effect, euro pressure, dollar strength, then policy talk, then dollar wobble, then more hedging, then more gold. That's how the spiral becomes self-reinforcing. The key point is this. A trade war makes both sides tempted to sacrifice currency stability to win in politics, and when that temptation exists, gold becomes the neutral vote. Now, here's what turns this into mass exodus. Institutional money doesn't move because of one headline. It moves because the risk manager's checklist changes. When risk managers feel a new regime, they change haircuts. They change limits. They change what counts as acceptable collateral. They change how much liquidity must be held. That creates demand for hard collateral, and gold is the original hard collateral. So the exodus from paper money begins the moment. Paper is still money, but is no longer treated as unquestionably safe collateral. That's the turning point. And the irony is, you might not see it immediately in everyday life. You don't see the committee meetings. You don't see the internal memos. You don't see the quiet rebalancing. You only see the result on the chart, gold surging, currencies wobbling, volatility rising, headlines getting louder. But the real shift happens in the background. Standards are tightening. Now let me give you a real-world mental picture. Think of global finance like a massive warehouse. Inside that warehouse, every transaction is a pallet moving from one aisle to another. Currencies are the forklift keys, collateral is the warehouse pass, and trust is the electricity keeping the lights on. Trade war is the moment the lights flicker. Not fully off, but flicker. When the lights flicker, the first thing every operator does is slow down and secure what matters. They don't race faster. They don't take more risk. They protect inventory and protect access. That's what institutions are doing with gold right now. They're securing access. Now, if you're thinking, okay, but why would this happen so fast? Because confidence is a crowded trade. It feels stable because everybody shares it. The moment people suspect not everybody shares it, confidence can collapse quickly. That's why Exodus language fits. Nobody wants to be last. And in the financial world, being last is the same as being trapped. So you see gold print new highs, not because everyone suddenly loves gold, but because enough institutions decided they don't love paper the same way anymore. That's the trade war effect. It's not about metal worship. It's about rule risk. Now, there's one more layer I want you to hold in your head. In a trade war environment, capital doesn't just move into gold. It also moves into any asset that can survive policy shifts. That's why you often see commodities act weird. That's why you see strategic resources become bid. That's why you see volatility become a weapon. Because when policy risk rises, stable becomes expensive. Gold is expensive because stability is expensive. And when stability gets expensive, people start paying for it. That's what $47,100 means. It means the market is paying an increasing price to own an asset that is not somebody else's liability. Now, I want to bring this back to you. Watching the screen, if you are only watching price, you will get faked out. You will see a dip and think the exodus ended. You will see a spike and think you missed it. You will see a headline and think it's all hype. But if you watch it as a currency collateral story, you'll see the pattern. The pattern is this. Every time policy risk rises, demand for hard collateral rises. Every time demand for hard collateral rises, gold absorbs that fear. Every time gold absorbs that fear, it sends a message about paper confidence. And that message feeds back into the system, because gold going parabolic is embarrassing for paper. It forces questions. It forces scrutiny. It forces debate. And debates about money are never calm. Debates about money are always political. So a trade war doesn't just weaken currencies economically. It weakens them psychologically. It makes people ask, what if? And in finance, what if is enough. Now here's the practical takeaway of point 2. If you want to understand whether this gold move has legs, don't just watch the gold candle. Watch currency behavior under pressure. Watch how quickly officials move from economic language to political language. Watch whether the narrative becomes, we must defend instead of, we are fine. Watch whether capital begins pricing policy intervention as the default, because the moment intervention becomes expected, paper money becomes something you use, not something you trust. And that's the beginning of an exodus, a quiet one, a rational one, a bureaucratic one, but an exodus all the same. And in the next part, we'll connect this currency collateral spiral to the other signal the market is screaming through right now. What happens when the safe haven move collides with a metal that isn't just a store of value, but a real-world input under stress? Now, let me zoom in on the phrase I keep repeating, collateral questions. Because once you see this, you can't unsee it. In normal times, a currency is just a unit of account. In stress times, a currency becomes a gate. a gate to trade, a gate to credit, a gate to settlement. And trade wars are basically governments announcing, we are willing to pull gates up. Even the threat of gates changing forces institutions to adapt, because institutions are allergic to uncertainty about access. So what does that adaptation look like? It looks like a collateral waterfall. Not dramatic, not cinematic. A waterfall of boring decisions that compound into a stampede. It starts with the Treasury team. They look at their exposures and they ask, if this tariff fight escalates, what happens to our input costs? What happens to our demand? What happens to our financing? What happens to our FX hedges? Then the risk team steps in and asks a sharper question. If currencies swing and volatility rises, what happens to our collateral requirements? Because collateral requirements don't care about your opinion. Collateral requirements care about volatility. The more volatility, the more margin. The more margin, the more forced selling. The more forced selling, the more instability. That's the mechanical core of the spiral. So the institution does what institutions always do when the world turns unstable. They move from optimize to survive. They shorten duration. They raise cash buffers. They diversify custody. They demand higher quality collateral. And higher quality collateral is the polite phrase for less paper promises, more hard settlement. Here's why the trade war makes this worse than a normal macro scare. Because in a normal macro scare, everyone agrees on the referee. You might argue about rates, but you trust the rule book. You trust that settlement works. In a geopolitical scare, the referee becomes part of the game. Sanctions exist, export controls exist, license lists exist, emergency rules exist, and the market has learned a brutal lesson in the last few years. These tools can appear quickly, and they can be justified by almost any national security story. So when the US and Europe start sounding like rivals instead of partners, you get a new kind of FX fear. What if access becomes conditional? Conditional access is the ultimate poison for paper, because paper money is not just a number. Paper money is a relationship. It's a relationship between you and the issuer, between you and the banking system, between your country and their country. And in a trade war, relationships get renegotiated. That's why gold spikes. Gold is what you hold when you don't want your money to depend on the mood of a negotiation. Now, let me show you how this plays out in real time, because it's easy to miss if you're not watching for it. When headlines escalate, the first thing that moves is not the currency spot rate. It's the cost of insurance. Insurance is volatility. Insurance is hedging. Insurance is the price of certainty. When the cost of hedging rises, every institution that lives across borders suddenly feels poorer because their risk budget gets eaten. That triggers a second wave. They de-risk. They reduce cross-border exposure. They reduce complexity. They reduce reliance on the weakest rails. And this is the key. De-risking often looks like selling risk assets, but it also looks like buying settlement assets. Gold is a settlement asset. So is the highest quality sovereign collateral. So is anything that retains value when permission systems tighten. So even if you never see a dramatic currency collapse on the chart, the behavior underneath can still produce an exodus into gold. Because the exodus isn't about apocalypse, it's about standards. And when standards rise, paper gets treated like a second-class citizen. Let me give you another analogy. Think of paper money like a boarding pass. Most days it gets you on the plane. But if the gate agent starts checking passports more aggressively, suddenly the boarding pass isn't enough. Trade war is the passport check. It's the moment the world starts asking, who are you and what side are you on? Gold doesn't need a passport. Now here's the scarier part. Once currencies become collateral questions, the system can start creating its own stress. Because if everyone wants higher quality collateral at the same time, you get a squeeze. The definition of a squeeze is simple. Everyone wants the same thing now. So if institutions are trying to upgrade from paper trust to hard trust, the upgrade itself pushes the price of hard trust higher. That's not speculation. That's a crowding effect. And crowding effects move faster than fundamentals. That's why gold doesn't climb politely in moments like this. It jumps, it gaps, it shocks. Not because the metal changed, because the demand for certainty changed. Now, let's talk about the emotional side of the currency spiral, because psychology matters. When people lose trust in a currency, they don't immediately hate it. They start by doubting it. They still use it. They still settle in it. But they stop holding more of it than necessary. And that stop holding extra behavior is enough to move markets. If a corporation that used to keep 6 months of currency reserves decides to keep 3 months and put the rest into something neutral, that's a flow. If 10 corporations do it, that's a trend. If sovereign entities do it, that's a regime change. So the spiral doesn't require a collapse. It just requires a broad decision to stop treating paper as a savings vehicle. And that's exactly what exodus from paper money means in practice. Paper still works as a medium of exchange, but loses its status as a store of confidence. Gold absorbs the confidence. Now, if you want the cleanest summary of the second point, it's this. Trade war turns money into politics. And when money becomes politics, trust migrates to what politics can't print. That's why gold behaves like the scoreboard. It's the public thermometer of private fear. Now, I want you to notice something else about trade war spirals. They don't just hurt currencies, they distort information. Because every side has an incentive to say, we are strong. Every side has an incentive to downplay fear. Every side has an incentive to blame the other. So the public gets noise, but institutions don't trade noise. They trade risk. They read between the lines. They look at what policies are being drafted. They look at what tools are being discussed. They look at whether the conversation is shifting from growth to security. Because the moment a government frames economic policy as security policy, the risk posture changes. Security policy doesn't care about efficiency. It cares about control. And control is the enemy of free-flowing capital. So as soon as trade war language becomes security language, capital starts seeking non-political stores of value. Again, gold. Now, I want to go one level deeper into the mechanism, because this is where most people get trapped by the chart. Currencies are reflexive. Reflexive means belief affects behavior, behavior affects outcomes, outcomes affect belief. So if investors believe the euro will weaken, they hedge. Those hedges push pressure. That pressure weakens it. That weakening confirms belief. Same for the dollar. Same for any currency. In a trade war, the reflexivity intensifies because policy responses can be sudden. And sudden policy is the number one ingredient that makes institutions hate holding cash as a store of value, because cash is stable until the rules around cash are not. So in a spiral environment, people start treating cash like inventory. Keep only what you need. Move the rest into assets that can survive policy. That's the exodus. Now here is a hard truth. If you are waiting for a newspaper headline that says, the exodus has begun, you'll be late. The exodus begins when 1. Hedging costs rise. 2. Custody debates get louder. 3. Institutions tighten collateral standards. 4. And governments start talking like rivals. At that point, the system is already in motion. Gold doesn't wait for confirmation. Gold is the confirmation. So when you see $4,700, you should hear the subtext. Someone important stopped trusting paper at the margin. That's all it takes. Now, I'm going to make one more point about the downward spiral idea, because people misunderstand it. A downward spiral doesn't mean both currencies go to zero. It means confidence erodes and volatility becomes persistent. Persistent volatility is enough to cause real damage because it forces constant hedging, constant margin, constant repricing. And constant repricing makes planning impossible. If you can't plan, you can't invest. If you can't invest, growth slows. If growth slows, policymakers get more desperate. If policymakers get more desperate, currencies get more political. That's the spiral. So this is not doom. This is mechanics. Now, if you're thinking, okay, so what do I watch? Watch for any sign that policymakers are prioritizing political wins over market stability. Watch for language like strategic autonomy, economic security, retaliation, defensive measures, emergency powers, protected industries. Those phrases are not just politics. They are signals that the playing field is changing. And when the playing field changes, paper money gets treated like a risk asset. That's why the exodus begins. Because the smartest players don't wait for the crash. They move when the incentives change. And in 2026, trade war incentives are changing fast. So if you want to understand why gold hit $4,700, don't stare at the candle and ask, what happened? Ask, what standards changed? Because the gold chart is just the shadow on the wall. The real move is the migration of trust happening off screen. And this is why I keep calling it a mass exodus, even if the streets look normal. The exodus is happening in spreadsheets, not on sidewalks, in treasury memos, not in TikTok clips, in the boring questions that decide everything. Where is our liquidity parked? Which jurisdiction controls the rail? What happens if settlement slows? What happens if the trusted system suddenly has a side? When those questions start showing up in boardrooms, paper money loses its throne. It still works. It still spends, but it stops feeling like home. Gold becomes the neutral home. So the next time someone tells you this move is just fear, remember, fear is a feeling. Standards are a policy. And right now, standards are rising. And when standards rise, the scramble is not for yield, it's for certainty. Most people will miss while they're hypnotized by the gold headline. Silver is the physical stress meter. Gold is the trust vote. Silver is the availability vote. Gold tells you that institutions are losing patience with paper promises. Silver tells you whether that loss of patience is leaking into the real economy, into factories, into components, into the we cannot ship without this world. And today, while gold was printing 4,700s, silver was also breaching $95. That matters because silver doesn't move like a polite store of value. Silver moves like a supply chain that's about to get ugly. If gold is the referendum, silver is the pressure gauge on the plumbing. So if you're watching silver and thinking, okay, it's up, so what? You're missing the entire 2026 game, because silver is the metal where paper and physical split the fastest. Let me paint the scene in silver terms. Retail sees a number. Spot is $95. Spot is $93. Spot is $90. They argue like it's the truth. But serious buyers don't ask what's spot. They ask, what is the premium? They ask, what is the lead time? They ask, how many units can you deliver this week at size without excuses? They ask, can you guarantee allocation? Because in a physical squeeze, the spot price becomes the least important number on the screen. And if you're new to this, that sounds backwards. How can price be less important than price? Because price is a paper signal. Delivery is a reality signal. In 2026, you can have paper liquidity that looks fine and physical availability that is quietly screaming. That's the split. That's the trap. That's the fake out that makes people sell the wrong thing at the worst time. So when I say silver is the stress meter, here's exactly what I mean. Gold can rise because people are afraid of paper. Silver rises when fear collides with necessity. Gold is what you buy when you want insurance. Silver is what gets bought when someone needs production to continue. And that is why silver at $95 is not just another metals rally. It's a warning that the exodus from paper is starting to touch the supply chain. Now let's talk about the West for a second, because that's where the psychology is changing fast. For years, Western markets treated metals like a trade, a positioning game, a CPI hedge, a meme. But in 2026, the tone is different. In the West, this is starting to look like a panic move by institutions, because institutions are finally acting like the currency war can spill into the real economy. And if you believe the US-EU trade war could make the euro and the dollar wobble into a mutual confidence loop, then silver becomes a very specific kind of asset. It's not just value, it's inventory, it's a strategic input, it's a bottleneck that can't be printed. Think of silver like the tiny bolt in a machine that costs $0.50. If that bolt disappears, the entire machine stops. That's silver, solar, electronics, medical, solder, high-efficiency contacts, thermal management, chemistry, 1,000 places where you don't notice it until you can't get it. So the moment big institutions smell downward spiral risk in currencies, they don't only run to gold. They start asking, which real-world inputs become scarce if trade gets weaponized? And silver jumps to the top of that list. Now here's the key distinction you have to keep straight. Gold is financial flight. Silver is financial flight plus industrial pull. Gold can run without immediate physical stress. Silver cannot, because silver has an industrial heartbeat. And in 2026, that heartbeat is accelerating. So what does a silver stress meter actually look like in real time? It looks like this. Spot dips, but physical stays tight. Spot dips, but premiums don't break. Spot dips, but delivery times stretch. Spot dips, but wholesalers whisper allocation. Spot dips, but the shelves don't refill. That's not normal. That's what a tug of war looks like when paper sets the headline price and physical sets the real constraint. And it creates the most confusing market structure on earth, a market that can look weak on the chart while getting tighter in the real world. That's how people get shaken out, because they watch the chart, see a red candle, feel stupid, and bail. Meanwhile, the serious buyer is using the dip to secure the next truckload. And yes, truckload is the right word, because silver doesn't matter as a number. It matters as a flow, bars, grains, sheets, paste, contact material, industrial form. Silver moves through factories like blood. If the flow gets restricted, the whole body feels it. Now, this is where the trade war narrative makes silver even more dangerous and more explosive. Trade war doesn't just raise costs. Trade war creates uncertainty in shipping, licensing, approvals, and cross-border timing. And timing is the real killer in industry. A price increase is painful. A delivery delay is fatal. You can budget for higher input costs. You cannot budget for missing your ship date when your product cycle is timed to the quarter and your penalties are contractual. So when institutions fear trade war escalation, they start pulling demand forward. They buy earlier. They lock supply. They take inventory out of the visible market. And the visible market is what retail watches. That's why retail gets blindsided. Retail sees calm. Retail sees a dip. Retail thinks bubble popped. But underneath, inventory is being absorbed by entities that do not care about the candle. They care about the pipeline. Now let me say something that might sound provocative, but it's just mechanics. In a real physical squeeze, volatility becomes a weapon, not a bug, a weapon. Because the fastest way to transfer physical inventory from weak hands to strong hands is to create fear at the margin. You run price up. You get everyone excited. You hit a headline. You slam the paper market. Stops trigger. Leverage gets liquidated. Weak hands puke. And then the quiet buyer, who never needed the chart to feel brave, gets supply without chasing. That's how commodities get accumulated when the real constraint is delivery. So when you see silver whipping around, don't treat it like chaos. Treat it like a harvesting tool. The system uses volatility to locate metal, to coax sellers, to scare out inventory. Because straight lines up are bad for procurement. Straight lines up attract attention. They make suppliers hold back. They make everyone wait for higher. Volatility makes sellers show up. Now, does that mean everything is a conspiracy? No. It means incentives are ruthless. Incentives create behavior. Behavior creates patterns. Patterns look coordinated because everyone is responding to the same survival logic. If you are an industrial buyer and you sense that silver availability could tighten, you don't want the price to go vertical in public. You want cover. You want pullbacks. You want a market that lets you accumulate without setting off alarms. A dip is cover. That's why silver at $95 is such an important tell. It means the demand is strong enough to push through the noise. It means the metal is being treated like it matters. And in 2026, it matters because we are stacking stress on stress, currency stress, trade stress, policy stress, supply chain stress. Silver lives at the intersection. Now, I want you to lock in one mental model because it will save you from getting faked out this year. Stop treating silver like a single market. Silver is two markets. Market one, paper price discovery, futures, ETFs, leverage, narratives. Market two, physical allocation. Bars, industrial forms, contracts, premiums, delivery schedules. Most years, those markets talk to each other. In 2026, they're starting to argue. So you can have a day where the paper market says down and the physical market says tight. And if you only listen to paper, you will make the wrong decision. That's why the third point matters. Silver is the stress meter because it tells you whether gold's trust vote is bleeding into real-world constraint. If gold screams and silver is sleepy, it's mostly financial fear. If gold screams and silver is screaming too, the fear is moving into procurement. And procurement is where things get serious. Procurement is not emotional. Procurement is math plus deadlines. Procurement doesn't care if the chart is overbought. Procurement cares if the production line stops. So when silver starts acting like a bottleneck, you should assume serious buyers are involved. Now, how do you validate this without guessing? You watch the plumbing. Here are the silver signals that matter when you suspect a physical tug of war. 1. Retail premiums. Do coins and small bars stay expensive even when spot cools? 2. Backorder language. Do dealers start quietly extending lead times? 3. Wholesale tightness. Do big lots become harder to source at consistent terms? 4. Curve behavior. Do near-term contracts stay tight relative to longer dates? 5. Physical versus paper disconnect. Do red candles on spot happen while physical remains no deal? 6. Industrial language. Do more companies call silver critical, strategic, supply constrained? 7. Substitution talk. Do you start hearing, we redesigned contacts, we reduced silver content, we're testing alternatives? Because substitution is the final stage of stress. You don't substitute because it's fun. You substitute because supply got political or expensive or unreliable. And when you hear substitution, you are not in a normal commodity market anymore. You are in a resource regime. Now, here's the uncomfortable truth that ties the whole story together. Gold is the alarm, silver is the smoke. Gold ringing a bell is one thing, smoke in the hallway is different. Silver at $95 is smoke. It is the market hinting that real-world demand is tightening at the same time. Financial fear is rising, and that combination is explosive. Because when financial fear meets industrial necessity, you don't get a gentle bull market. You get a market that behaves like a rationed resource. Rationed resources don't move smoothly. They lurch, they spike, they fake out, they punish late buyers and early sellers, and the punchline is always the same. The metal moves from the visible market into long-term contracts and private channels. That is what exodus from paper money looks like when it reaches silver. It looks like metal leaving the public screen. Now, I want to bring this back to the title and make it crystal clear. Gold hitting $4,700 is the headline. The mass exodus from paper money is the behavior. Silver at $95 is the confirmation that the behavior is not just financial, it's becoming physical, because silver is where paper has the hardest time pretending it's reality. You can create infinite paper claims. You cannot create infinite atoms. And when the world starts prioritizing real settlement over paper claims, silver becomes the battleground metal. That's why, in the West, this doesn't feel like investing anymore. It feels like institutions quietly admitting, we don't want to be trapped in paper if this trade war turns into something worse. So next time you see silver whip around and you feel your brain screaming, crash, stop. Ask the only question that matters in a physical market. Is the metal getting easier to get or harder? Because if it's getting harder, volatility is not the story. Volatility is the tool, and the people who understand that don't panic on a $2 move. They use it to secure the next shipment. Closing this third point, remember, in 2026, the loudest screen is not the most important screen. The loudest screen is the chart. The most important screen is the delivery schedule. And silver is the metal that forces you to look at the delivery schedule. One more time, drop a comment with one word. Paper, if you think this is all price action and emotion. Delivery, if you think silver is exposing the real fight off screen. Stay sharp, stay calm, because in 2026, the chart is the distraction, delivery is the story. But I want to go even more practical, because people hear plumbing and they still don't know what to look for. So here's what a real silver squeeze feels like from the ground, not the chart.
It feels like, sure, we can quote you, but the quote has conditions. It feels like we can deliver, but the timeline is vague. It feels like we have stock, but the size is capped. It feels like we can fill part of it now and the rest later. It feels like suppliers asking for deposits, prepayment, or contract language that didn't exist in quiet years. And none of that shows up on your candlestick. That's why silver is the stress meter. Because silver is the metal where small frictions become big consequences fast. Gold can sit in a vault for decades and still do its job. Silver has to move. Silver has to be consumed. Silver has to be delivered again and again and again. So the moment delivery gets even slightly annoying, the market response isn't meh. The market response is hoarding, contract locking, and pulling forward demand. And when demand gets pulled forward, the shortage becomes self-fulfilling. That's the hidden engine of a physical run.
Now let's talk about the premium paradox, because this is the single cleanest tell that silver is in stress. In a normal market, spot down usually means physical down. Premiums compress, availability improves. In a stressed market, spot down can make physical tighter because the dip becomes a buying window. So premiums stay sticky, lead times don't improve, inventory doesn't refill. That paradox, spot weak, physical tight, is your red flag. It tells you the paper price is functioning as a headline, while the real market is functioning as allocation. And allocation is where wars start. Because allocation means someone somewhere is deciding who gets metal first. And when allocation exists, small buyers learn a painful lesson. You can be right on price and still be wrong on access. Now here's why I keep saying the West is panicking, because it sounds dramatic, but it's actually just timing. Historically, the West is late to physical stress. The West trusts paper. It trusts liquidity. It trusts that if there's a price, there's supply. That's not stupidity. That's habit. That's decades of a system working. That's complacency created by stability. But trade wars attack stability. They inject uncertainty into rules, and uncertainty makes paper feel fragile. So Western institutions, slow, conservative, committee-driven, begin changing their behavior. First, they increase hedges, then they diversify reserves, then they start asking about custody, then they start asking about delivery. That is the migration path. And the moment delivery questions start showing up in Western boardrooms, silver becomes the metal that reveals whether the system is still healthy. Because you can fake confidence with speeches. You can't fake a shipment. A shipment either arrives or it doesn't. Now let's map the 3 stages of a silver stress cycle, because if you understand these stages, you'll stop being emotionally whiplashed by headlines. Stage 1, denial. Spot moves, everyone argues. Physical is a little tight, but people say it's temporary. Premiums are a little elevated, but people say it's seasonal. The market still thinks paper and physical are the same thing. Stage 2, ration. Suppliers start limiting size, delivery windows stretch, contracts get stricter, substitution talk appears. The market starts treating silver like a resource, not a trade. Stage 3, repricing. The paper market tries to catch up to the physical reality. Price spikes, then gets smashed, then spikes again. Volatility becomes violent. The public sees chaos. The insiders see inventory transfer. Silver at $95 in a gold panic environment is a stage 2 smell. It doesn't mean the end is here. It means friction is rising. And rising friction is what turns a normal market into a strategic market. Now let's talk about the paper stack problem in silver, because silver is where the paper stack is the most psychologically dangerous for retail. When people buy paper exposure, they feel like they own silver. They say, I'm in silver. But in a true physical stress event, being in silver is not the same thing as controlling silver. So the paper stack becomes a confidence amplifier. It makes the crowd think supply is infinite because exposure is easy to buy. And then one day, the crowd discovers the difference between exposure and possession. That discovery is always traumatic, because it arrives during volatility. It arrives during headlines. It arrives when everyone wants the same thing at once. And that's why silver is the stress meter. It's the metal that forces the market to confront the meaning of ownership. Now I want to do a quick micro scene, because this is how it really plays out. 2 people are watching the same silver chart. Person A is retail. They see 95s, then 93s, then $90. They feel mocked. They feel manipulated. They feel like the market is a casino. Person B is procurement. They see the same chart, but it's not the screen they're focused on. They're looking at a spreadsheet of suppliers. They're looking at delivery schedules. They're looking at penalties for late shipment. They're looking at quarterly targets. When spot dips, person B emails suppliers, confirm availability, confirm timing, confirm allocation. Person A posts, they're smashing it again. Person B signs a contract quietly and moves on. That's the split. And in 2026, the market is increasingly being driven by person B behavior. That's what makes silver different now. Now I can already hear the comment that always shows up. Okay, but if it's so tight, why isn't price straight up? Because price isn't the scoreboard you think it is. In a paper set price system, the scoreboard is designed to be noisy. Noise keeps supply flowing. Noise keeps the public uncertain. Noise creates liquidity. Liquidity is how large entities get what they need, so price does not have to reflect stress immediately. Stress reflects in access first. That's why premiums, lead times, and allocation language matter more than a candle. Now here's a brutal sentence that describes the whole game. In a physical market, the winner is not who predicts price. The winner is who secures flow. Flow beats forecasts. If you control flow, you can survive price. If you only forecast price, flow can ruin you. That's the silver lesson. And that's why gold hitting $4,700 matters so much to silver. Because when gold is screaming, the system is already anxious. And anxious systems pull forward demand. They demand certainty. They demand delivery. So silver becomes the metal where anxiety turns into action. Now, if you want to really understand why silver behaves like a stress meter, think about the difference between a savings account and a factory. A saver can wait. A factory cannot. A saver can choose not to buy this week. A factory has production schedules. A factory has customers. A factory has penalties. So industrial demand is sticky. It's not optional. It's not maybe later. It's we need it. And the moment trade wars threaten the smoothness of cross-border trade, factories and procurement teams become conservative. They stop running lean, they start stocking buffers, they stop trusting just in time, they move toward just in case. That shift, just in time to just in case, is a massive demand shock all by itself, because the whole modern world was optimized to hold minimal inventory. So when that philosophy reverses, every strategic input gets bid. Silver is a strategic input. Now, I'm going to give you a simple yes-no test you can run every week to know whether silver stress is building without guessing and without doom. Ask, is the market behaving like abundance or like rationing? Abundance behavior. Premiums compress on dips. Delivery gets easier. Suppliers compete. No one demands prepayment. Inventory refills. Rationing behavior. Premiums stay stubborn. Delivery windows stretch. Suppliers limit size. Contracts get stricter. Substitution talk increases. You hear allocation and priority. If you see rationing behavior while spot is volatile, that is not bearish. That is stress. And stress is what produces explosive repricing later. Now, let's tie this to the emotional coaching, because if you don't master this, you'll get used as inventory. When silver drops $2, your nervous system screams danger. That's normal. That's human. But in a physical stress regime, that fear is often the exact mechanism that transfers metal out of emotional hands. So your job is not to be fearless. Your job is to be accurate about the game you're in. If you are in a normal speculative regime, volatility is random. If you are in a physical stress regime, volatility is often purposeful. Purposeful doesn't mean conspiratorial. It means incentives produce patterns. And patterns produce transfer. So when the crowd is screaming crash, you don't have to be a hero. You just have to ask, did anything in the physical world get easier? If nothing got easier, then the fear may be the feature, not the bug. Now I want to land this point with a clean, memorable takeaway. Gold tells you the system is doubting paper. Silver tells you the system is doubting delivery. Gold is a confidence story. Silver is a logistics story. And logistics beats narratives every time. You can argue with a chart, you can't argue with a missing shipment. So yes, gold at $4,700 is historic, but silver around $95 is the tell that history is starting to touch the real economy. That's why I keep calling silver the stress meter, because silver is where the system's promises meet the system's limits. And limits are what move markets when trust breaks. Closing this third point, remember, in 2026, the loudest screen is not the most important screen. The loudest screen is the chart. The most important screen is the delivery schedule. And silver is the metal that forces you to look at the delivery schedule. One more time, drop a comment with one word, paper. If you think this is all price action and emotion, delivery. If you think silver is exposing the real fight off screen, stay sharp, stay calm. Because in 2026, the chart is the distraction. Delivery is the story. And if you want a simple weekly dashboard, here it is. 3 signals, no drama. Signal 1, the premium spread. Track the gap between spot and what real metal costs where you are. If spot falls and that gap refuses to shrink, the market is telling you physical is still being defended. Signal 2, the time spread. Ask how long delivery takes for meaningful size. In a healthy market, time tightens on dips. In a stressed market, time stays stubborn because every dip gets bought. Signal 3, the language shift. Listen for words like allocation, priority, limited, delays, strategic, critical. Markets change first in language, then in policy, then in price. Do that, and you'll stop being whiplashed by every candle, because silver is not just a chart, it's a lie detector for the whole system. And one more thing, watch who is calm. When a market is just speculation, the loudest voices are the buyers. When a market is becoming allocation, the calmest voices are the buyers, and the loudest voices are the sellers who need liquidity. You'll see it in the behavior. Dealers stop discounting and start quoting. Wholesalers stop advertising and start screening. The product page doesn't say in stock, it says call. Now that's not marketing, that's triage. Because in a physical tug of war, silver doesn't disappear everywhere at once. It disappears in the sizes and forms that matter first. The squeeze starts at the industrial edge, then creeps into retail, then finally shows up on the headline chart after the metal has already moved. So don't wait for the chart to confirm what the shelves already know. Remember, gold is the alarm bell. Silver is the hallway smoke. If the bell is ringing and the smoke is thick, you don't debate the forecast. You secure resources. That's why a $2 dip can feel bearish on a chart and still be bullish in the real world. It's the moment fear turns into inventory transfer. Stay clinical, watch delivery. When price screams, ask, did premiums fall? Did lead times shrink? Did anyone get more metal? If not, stress rises.